Paul, thanks for coming on today. I want to talk a little bit about the foreign currencies. I want to talk a little bit about the dollar, but definitely the focus this week being on the Fed. You know, I'm wondering, let's start with the dollar actually, because again, with the focus on the Fed this week, I'm wondering what you're expecting in terms of any reaction from the Fed. It sounds like everything's for the most part baked in as far as a rate hike on Wednesday, but I'd assume that we're going to be listening for any comments in terms of December and next year as well.
Yeah, that's really going to be the key is the forward guidance and where all the dot plots are and what the expectations are. I think really more than the statement is going to be the press conference afterwards where we get a little bit of Q&A and we get some answers maybe from Powell about what the expectations are going forward. What's interesting to me is when you take a look at the dollar's actually come off. It's down at the low end of its trading range now, that 92 to 94 level. It's been trading in now for a while, and we're down at the low end of that range. And again, the traders are really very bullish on the dollar, very negative on many of the foreign currencies. So the pain trade would be to see further dollar weakness, which really does not line up with higher interest rates and some of the things that other guests have been talking about. What's interesting, too, is if that gold market does pick up here, that would be an offset to the dollar, and the dollar could trade down. So, again, the dollar's, I think, at some key support areas right now, and a break here, I think you could see further weakness on the dollar. Trade obviously plays a role in that, but I think the Fed is going to be the key for this week.
Paul, if we did see some weakness here this week, considering the strength that we've recently seen in some of the treasury markets, would that point to, well, canary in the coal mine kind of indication that something's a little bit out of whack, something's a little amiss here?
I think so. The more I looked at it, and I took a good look over the weekend, and one of the things, you and I have talked about it a while back, we're seeing higher interest rates, we're seeing a stock market that's kind of blissfully higher, and we're seeing a dollar that's had some trouble here. And I go back to 1987. This is similar action to what we were seeing in 1987 before the crash. Not that we're expecting a crash, but there's similar things that are going on that may lead to weakness in the equity markets here. But you're right. I think the interest rate market is one really to watch here. The surprise has been on the long end of the Treasury, where we've seen that rate get significantly above 3%. Sticks there, we could see some trouble going forward.
You know, Paul, last week we saw a little bit of a lift in the pound, which actually added to some of the weakness that we've been seeing in the dollar and that we've been talking about. But I'm wondering, because there was some of it was associated with some optimism associated with Brexit, but some of it was also associated with some of the numbers that they got out of some big retail sales numbers. They had some higher than expected inflation data, which also came in, again, very strong. I'm wondering, is it possibly too early to tell, but is the strong U.S. economy starting to create a bit of a ripple effect?
I think it is. You know, when you take a look at the global trade picture, we're still doing a fair amount of trade. We're still doing a lot of buying from foreign countries. We're seeing our trade deficit actually weakening here. So when you take a look at the British pound, that has actually had a great run over the last 6 weeks or so. And the comments from Theresa May, the economic data, we're hearing from the Bank of England, Carney, about maybe raising rates. We're getting some more rumblings out of Mario Draghi that they're closer to raising rates. They're really conditioning the markets now for global higher interest rates. The U.S. is a year and a half ahead of everybody else. But if we get that global tightening in rates, we could see some interesting things going on, not only in the currency markets, but certainly that'll bleed over into the equities and a lot of the commodity markets as well.
Paul, we touched on higher rates earlier, but I want to take a closer look at what caused the recent rate spike. A couple of our guests last week seem to think that tariffs are creating inflationary pressures. I'm curious if you agree. Are tariffs a form of inflation?
Oh, they are absolutely a form of inflation. The problem is we're not seeing it yet. We're seeing very little of the inflationary pressures that we would expect to see. We're just now getting around to some of the very large tariff implementation. We should see those in the numbers after the first of the year, so probably not until January, February's numbers. So we're a long way away from that. We haven't seen much in the way of the steel prices picking up. We have not seen that come through in the numbers. The core rates of inflation still pretty good. PCE is still pretty good. We're seeing modest inflationary pressures. I think what we're seeing really is some of the issues around our debt issuance. We've seen a huge issuance the last couple periods, and we're seeing some of the buyers stepping away. China is actually one who stepped away a little bit from the auctions. So again, very large supply. Not as much demand as we've seen historically, and I think that's really kind of what's behind at least the short-term move higher in interest rates, especially on the long end.
Paul, we always talk about China and how they can't necessarily combat us dollar for dollar in terms of trade tariffs, but you mentioned they're stepping away a little bit from the U.S. bond auctions and some of our debt auctions. I'm curious if that's a way that they can kind of combat or sort of in a passive way express their discontent in terms of some of the tariffs that they're dealing with.
I think that's part of it. Certainly because they've had such a huge trade surplus with the U.S., those dollars have come back to the United States in the way of purchasing of treasuries. So the fact that they're stepping away a little bit, they've been a little bit more easy, if you will, on their currency, allowing it to depreciate a little bit more. So those are some of the ways that they're combating the issue with trade tariffs. And certainly the comments over the weekend this morning that they're stepping away as well, not interested in any further talks, has created some concern, certainly in the markets, and has created a little bit of unease this morning as we start our Monday trades.
So, Paul, one of the things you mentioned is that some of the trade tariff inflationary pressures haven't really reached the market yet, possibly a little bit more in 2019. We'll start to see them come up. But I wonder if that's why we saw the spike in rates last week, as the futures, or in theory, again, the markets are always kind of forward thinking. I mean, imagine that they're thinking that we're going to see some, higher rates to come if we continue to see tariffs, because we're going to need to raise rates to combat some of the inflationary pressure.
That's one of the interesting things that I'm not quite sure is how the market's really looking at this. The Fed is certainly going to be raising rates this week. They're probably going to raise rates in December. We're getting very close to an inverted yield curve. We're not seeing the economic growth that we did in the second quarter. That's kind of come off here a little bit. Again, not calling for the recession at this point, but some of the arrows are certainly pointing that way, late 19, early 20. So again, the short end is the part that we're really more focused on. If we do get that inverted yield curve and it pushes higher, and that's one of the things we're going to be interested in Fed talking about this week, we could be arguing more for lower rates than higher rates if the U.S. economy really slows. And remember, the U.S. economy is really what leads the world markets. We were the first one coming out of recession. We will probably be the first one going into recession. Again, sometime later. So if you think of it as a very long train, the U.S. is at the front end of that, and where we go, the rest of the globe will eventually follow. The rest of the globe right now is experiencing and has experienced some very good growth that's now starting to come off the boil here a little bit.
So, Paul, one more question, then I'll let you get out of here. I'm curious if we were talking about the shorter end of the, Treasury markets or yield curve, whichever you're looking at, leading. In this case, we've been watching as rates have been on the rise. Should we be keeping a close eye on the shorter end Treasuries right now for an indication that things are starting to slow and that we might be shifting into a bit of recession?
That right now the trend is certainly very strong on the upside. I think you're going to see that indication more on the long end than you will the short end. The long end is really going to be the one that's going to be keyed more to the inflationary pressures. The short end, not so much. And we're now right about 2.5 standard deviations above trend. So we would expect things to kind of cool off here a little bit. The trend that we've seen, I don't think can stay in place much longer without breaking something in the global market. And that's one thing that we're going to be watching for, is a lot of the economic data coming out of the global markets over the next 4 to 6 weeks or so.